Welcome. Thank you so much for joining the Nest Edge for today. We like to hold the Nest Edge to educate clients and our audience about what's going on in the markets, what's really going on in the markets, aside from what financial media tells us is going on, but also give an update on portfolios and what we see coming down the pipeline. And so here I have with me is Sean McDougle. He's our Chief Investment Officer, and yeah, we're just gonna get right into it and kind of, oh, one thing I just always have to mention is that these webinars that we host, the Nest Edge, are for educational purposes only. So if you do have any specific questions about investment, your own portfolio, or seeking investment advice, please reach out to us directly and we'll be happy to set up a one-on-one visit, call, in person now that COVID is calm down a bit. We can actually see real people. But yes, so to get started, what we like to do is kind of touch on some points that Sean shares in his Nest Edge that we release on a monthly basis. So this one is called Pivot Divot. And so what we see here is that for almost a decade, at least, the U.S. economy has kind of been having a good old time with a lot of cheap money. Interest rates have been suppressed for so long, and now that is not the case. So the U.S. economy, as Sean likes to put it, is now experiencing a hangover. From all of that, cheap money that our economy has been drunk off of for a long time. So yeah, wanted to ask Sean about this. We've seen rates, of course, change. The Fed actually doing what they said they were going to do is increase rates. I believe it's been 6 times this year already. Um, five, 6 times, or a sixth one is
Many
coming. I know it's
times,
five.
many times.
Many times. And so with all of the borrowing that's going on, what do we see? What have we seen happen? And what more can come from these rates increasing?
Is that my cue?
That is your cue, Sean.
Was there a question in there, or was that? Am I just jumping in? 'Cause, like, I need guidance in these webinars, or I will
Yeah,
burn all the time talking about stupid things. So,
yeah,
what am I starting? Where are you spinning me first?
yeah. About all the borrowing that's been going on. A bunch of
Oh,
cheap
yeah.
money.
I mean,
Well, we
yeah,
were
it's
already
not a
seeing this in the real
secret.
estate economy as well. Well,
Yeah,
commercial real estate, but
this is
yeah,
not a secret. We've been talking about it. I don't know. I feel like the last year, this whole year has been Groundhog's Day. I'm just like saying the same damn thing over and over and over. So like maybe by now the clients are like, wait a minute, this sounds exactly alike. Because it is. I'm just repeating myself. Nothing has really changed in our outlook, other than it could be worse. As Gloria mentioned, yeah, we've been surfing on low interest rates, and you're seeing a lot of companies that the only way they can make money is in those low interest rates environments. Crypto. uh, Not saying I said this was going to happen, but I definitely said this was going to happen. There's a lot of crap out there, specifically in that space. A lot of, you see this at, when markets, the business cycle, the sine curve, however you want to say it, when it starts to roll, the people that die the first on the roller coaster are the ones that were the most speculative, the most out there, and the most debt reliant. And that's, what we're seeing in the crypto world. It's a lot of speculative stuff. That's when you get on those farther ends out in the reaches, that's where you see the fraud as well. That was probably occurring for a long time. But it takes a market shock for things to kind of get shown. But right now we're seeing the crypto market as we knew it the last, 5 to 10 years eroding. And 08, 09, that exposed Bernie Madoff. He probably would have gotten away with another decade if the housing crisis didn't happen. That's kind of the water recedes, the king, da 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 da. The corporate side of things is just as bad. Let me rephrase that. It's not as bad as crypto. Crypto is a wild Looney Tune. There might be some parts of that markets that hang around, and regulation is probably coming right down the pipe. That's usually why regulation happens, is people lose a lot of money, so the government steps in and starts regulating it, which I think is hilarious, because that was the whole part of why crypto was supposed to be special, was because it was decentralized, deregulated, and the same problem has appeared itself in a decentralized deregulation. Fraud. If billions of dollars could be made, it's gonna, people, it's gonna bring in the wrong characters, human nature, and that's what we're seeing right now. So regulation is right around the corner. A lot of big names are losing a lot of money in this and got a lot of egg on their face. But all that being said, we're going to stop at the crypto thing because I've already talked about it too much. The corporate side is the side that's really the scary side. I've been talking about this for even longer than this year's. The corporate debt bubble has never been larger. And investment grade credit, just bonds from like good companies, is even looking dicey. The companies that we thought would never have issues are looking a little suspicious right now. And that's the real thermonuclear bomb, as I've called it in the past 2 years. Like, I've been talking about the debt bubble for a couple of years. Balance sheets have never been higher in corporate America than right now. And we are probably, going into what could be the biggest economic slowdown that we've seen since the 80s. So I would not want to be in those boardroom meetings because they're trying to get real creative and find ways to not get their, stock smoked to protect credit. Not credit. Shareholders. There you go. That word. It's, we got a credit problem in the corporate America space. The credit space on I guess you would say, like, the credit card consumer debt is rising at rapid rates. So, like, we're seeing all the normal, like, telltale signs that I hate using the word recession, but like, because it's so media clickbaity, but we're going into a slowdown. And I'm one of the people, I don't think it's a bad thing. I think we're long overdue for this. It's a normal part of the business cycle. It's a healthy part of the business cycle. Some companies, I've been saying this. If I just did a review with you, you probably heard me saying this. Like, some people need to go out of business. Like, it's a natural, normal nature, a society thing, and there needs to be some blood. There needs to be some. There's too many companies, zombie companies, that are just moving along, surviving on low interest rates and these crazy valuations. And this is when they usually die. Is when the business cycle turns. And it's a normal, healthy thing. I'm not concerned. I'd be way more concerned if I was long this stuff with leverage. But all the models are very conservatively positioned. They will be for
Sean,
the foreseeable future. Yeah,
before you
sorry,
get
I'm
into
moving along.
I know, before you get into the portfolios, there's one thing I want to touch on, and just to expand a little bit on, actually, is that, why we see interest rates rising, affecting the corporate markets, but also, corporations, but also like commercial real estate, is because when it gets more expensive to borrow money, and I'm just expanding on this so that the audience can have a better understanding of why interest rates are significant in the corporate setting and commercial real estate setting, is that when interest rates go up, there are higher debt payments. And when cash flow is not increased, meaning that sales are down, production is down, that's where you get a problem. More money is going out the door. So we're seeing this, as Sean mentioned, in the corporate space, but we're also seeing this in the commercial real estate space. There are some REITs that we follow, and that we observe for some of our clients, and we're noticing that there are some cracks in those REITs, meaning that there are loans that are being due on these $50 million properties. They're terming this month, beginning of next year, and occupancy is down, it's down to 70% occupancy. Some buildings are down 50% occupancy rates. And so this is very alarming because it shows that cash flow is decreasing. But for them to refinance, or to get a new loan, payments could double or triple. a month easily.
Classic margin compression, late
Yeah.
cycle. This is academia could even have called this one. I mean, it's what happens. This, and
So when
it'll
you
happen again in
when
5
you
to
talk
10
about
years.
this, like the economy being drunk on, cheap money, drinking, as Sean mentioned, like Coors Lights and, a
I
bunch of
believe what you
Mickeys
say.
or whatever's being, whatever cheap alcohol is popular these days, I guess. You know, After some time, like that's gonna hit you in the face pretty hard. And that's what a lot of these companies are experiencing. And so yeah, I just wanted to expand on that a little bit so people have a better understanding of why interest rates are so significant, especially in the corporate world, a corporate setting, but also going into commercial real estate. And so, yeah.
Yep.
But yeah, with that, Sean, yeah, you can go into the portfolios, how that's doing, and how we're set up and what we're, what's the projected outlook. What is your crystal ball saying, Sean?
I don't know. I don't have one. Do you have one?
Mine's in the shop,
Is in the
as you know.
shop.
Yeah.
Yeah.
Mhm.
Yeah. Our portfolio construction has been very similar for the last, I don't know, 4 months. Almost no equities, even our most aggressive stuff. There are some stuff that's on my radar, staples and healthcare. Um, no treasuries, no bonds of any sort. Really, just a lot of U.S. dollars. I mean, it's been I guess, our breadwinner this year. The U.S. dollar's up huge. It's flat today, but it's up around 16% this year, which is insane. We continue to see the probability of that's going to be up for the next few months. Again, the Fed has a lot of control over what happens there. When they continue to do what they said they were going to do, which is the most probable scenario. I think I've been very vocal about this, that the Fed completely screwed this whole thing up. They started tightening a year too late. Now's the time where, you don't want to be tightening into a slowdown, but that's usually what they do. They are going to continue to raise rates as they've done all year. I don't see, the most probable scenario is they rate hike again in December. They do another one in February. So February is the next one after that, and then they just sit for a little while. And the title of the Fed pivot divot is, as some of you know, I'm a bit of a golf addict. A divot is a hole in the ground after you hit your ball, and that's kind of what is going to happen to people if they keep praying for this Fed pivot thing. It's like your face is going to turn into a divot. Like there's been so many people chase this stupid narrative that like, oh, inflation has gone from 8.2 to 7.7. The Fed's going to start cutting rates. Like, what? And I get it. Like, so many people in this industry need things to go back to the way it was. So many people need equities to go up for them to make money. I went to like this, Gloria knows this. I went to this, like, I don't know how to describe it, but basically a inner industry dinner or lunch yesterday, and all the guys and gals that were sitting at my table, I left early because I couldn't listen to them talk anymore. It's insane what some of my peers out there think and hope and need to happen. And that's just kind of the vibe right now is, the only reason markets are down is because of the Fed. And as soon as the Fed starts cutting rates, which they're not going to do anytime soon, we're probably a year away from that. Uh, Once the Fed pivots, everything will be fine. Which is insane. It's it's bonkers. But all that being said, we are going to be very defensive until further notice. I think the things that will go in the next round when we start making major changes is treasuries and gold will go back into the portfolios. I don't know when that's going to happen. The CPI report last week was a step in the right direction for gold and treasuries. We will see if that volatility, we saw a big pop up in volatility in the treasury space yesterday, which kind of puts a pause on all of that. But if you put a gun to my head, as I like to say, gold treasuries will be the next thing that goes back in. Equities, springish, And again, I reserve the right to change my mind if the data changes, but that's the most likely scenario. we're going to be super defensive until further notice. Because I mean, the analyst phone call I was on this morning was one of, if not the most bearish I've ever seen. It's just the data's bad. It's getting worse. And if you read in between the lines, corporate America is trying to figure out how they're not going to go out of business. Like crap. As you said, revenues are down, costs are up, labor is up. I mean, layoffs are coming. That's the very first lever that they go and they pull. But that is only going to make the problem worse. If there's more people being laid off, there's less people going into Best Buy and buying flat screens. So it's a self-fulfilling, vicious cycle that we're walking into. And, again, the worst of it.
We're already seeing this with the hiring freezes that as you mentioned. It's like, hey, let's stop hiring new people. And what is the next step? Cutting.
Yep. Hiring freezes, firings, all of those, you're going to stop seeing buybacks, which has been a big contributor the last 3 to 5 years of this little run up, is because they could borrow money at cheap rates and then buy their stock back, which pumps up the stock price, which means the C-level suites get bigger bonuses. That's happened a ton. The S&P is down 18, Nasdaq's down around 20. Are we at the bottom? I don't know. But would it surprise me if we went down another 10? No. Like, I have immediate downside in the S&P. Where are we? I got 9%, 9.2% immediate downside in the next 2 weeks. That's the probable range. So that could change in 3 minutes, but that's the most probable scenario. We've had the big run up. CPI day, it was last Thursday. It was absolutely insane. We expected the move in treasuries and gold, but the equities market was absolutely comical. Like, like I think it was Amazon that was like up 12 after their earnings call. I was like, how in the hell are you guys believing this?
Terrible earnings call, by the way, for anybody who missed it.
Yeah, but it was up 12% that day. I was like, this is, American capitalism at its finest. These are the moments in time and space when people are going to, it's like when the movie The Big Short, about the housing crisis. It was very well done. It took a very complex scenario and made it, digestible and understandable. They're going to make movies about this window of time, and you're like, God, it's so obvious. It was so obvious. I was like, just like when you go watch The Big Short, it's like, oh, that was so obvious. Why did we do that? Like, this is, again, I said this 10 minutes ago. We're going to do this whole song and dance in another 5 to 10 years, because human nature. Everyone thinks, oh, this time's different. This time's different. Economic reality is not a real thing. So this is just normal. It's nothing to, freak out over or lose your mind over. Unless you read and watch CNBC or Bloomberg or Yahoo Finance, then you're going to freak out, because it's macro tourism. They're jumping from topic to topic. It's entertaining. If you like that sort of entertainment, I personally don't. I got better and more fun things to do with my time. They get stressed out over what whoever it is on the TV talking. I don't care.
So, good thing about our process, as our clients know, and I would like to reiterate to the audience, is that we look at data. We don't care about, slightly care about what the Fed does, but it's not reliable. We don't care who's in office. What we care about is what the data is saying. And that's what Sean follows in making investment decisions for our portfolios. As as many of our clients have heard, even our most aggressive portfolios are also in about 80 or 70% cash. And so during times like this, we're not going to stick.
That's definitely changed. After CPI, after Thursday and Friday last week, our most aggressive model is as short as it's ever been in my career. It is. Last few days, I've been it's.
Other than the last few days.
Other than the last few days, but it is.
Sean has made some significant changes, but prior to that, let me just rephrase and say, from beginning of the year to about October, Our most aggressive portfolios were in a majority of cash. And so, we're not stuck in static. We don't stick clients in static models, with the 60/40 split. We don't believe in that. We believe in being able to be active, being able to pivot and be very nimble in markets like this. And so, as Sean has said several times, when the bus is coming, get out of the way. And that's what he's been doing. And so, if you before we wrap up, I wanted to open it up to the audience to see if we have any questions. So I'm just going to take a look. All right. Don't have any questions posted at the moment. If anybody in the audience thinks of a question, please feel free to email us. Reach out to us directly, or you can email us at info at nestfinancial.net, and we'll be glad to give you an answer. Also, if this is your first time watching our videos, our Nest Edge webinars, or this is your 10th time, we would love to hear from you. So if you have any questions about your portfolios, or possibly know of somebody who is maybe has questions or struggling with theirs, please feel free to have them reach out to us. We'll be glad to talk to them one-on-one. But other than that, please keep in mind that these webinars are for educational purposes only. We love to educate our clients and the mass public. If you you know have any questions, please feel free to reach out. Other than that, we're going to wrap up for today. And until the next time, take care. See you soon. Bye,
Adios.
guys.